Hello everyone, this video will walk you through the experiment case study. Let me share my screen with you so that we can see what we're looking at. So here is the case study 3, the experiment. This is a movie I produced and I'm going to walk you through the financial elements we have used. It's an action thriller starring Adrien Brody and Forest Whitaker. Here is what we're looking at. First document that a sales agent will issue for you when you put together a film is a sales estimate sheet, and it looks a little like this. What you will see on the sales estimate sheet, as we see here for the experiment, you're going to see all the way on the left all the various countries, and then one column next to that you see the ask price column, which is the price level the sales agent is going to ask the distributor to pay. Then there is a column called target, which we also refer to as the take price column. That is the lowest price column that you want to refer to when selling your film to a distributor. Now here is what we're going to look at when it comes to the time that we're doing pre-sales. Pre-sales are done based on the script, the director and the cast of a project. The distributor reads the script, they look at who's in it, who's directing, and then they are willing to pre-buy a distribution license for their territory for this movie. So in this case, we pre-sold Benelux for $150,000. We pre-sold France for $250,000. We pre-sold Germany for $1.3 million, and so forth. So when we look at the experiment's sales report here, which is what this is, we see the actual pre-sales that were made, which altogether come to $5,116,800. The number right next to that is the take price number that was estimated as the lowest number we want to achieve for this film when we sell the international distribution rights. In this case, the take price was $9,170,000. This was an estimate. It was provided by the sales agent early on based on the fact that it's a thriller script starring Adrien Brody and Forest Whitaker and being directed by Paul Scheuring. When then, based on these elements that the sales agent went out to pre-sale, they were able to generate $5,116,800 in actual pre-sales. Now on the right here, you see the distributors that bought and some notes. We're not going to concern ourselves with that right now. The two numbers we are looking at for this case study is the estimate for the take, $9,170,000, and the pre-sales that were actually generated, $5,116,800. So let's play with this. The finance plan based on these numbers looks as follows. Our budget is $12,147,987. Again, the pre-sales that we generated were $5,116,800. When we do pre-sales, when the sales agent does pre-sales, the distributor will make a down payment. Usually the installment terms would be looking like we're paying 10 or 20% as a down payment as a distributor, and when the movie is delivered to the distributor, he pays the balance of 80 to 90%. So in this case, 20% of $5,116,800 is $767,520. This is our down payment. This is the first money that will be set aside for us to be used to cover our budget. The bank will then deduct this money because we already received it, and on the balance, the bank will charge an interest fee. In this case, the interest is 9.5%, which is $486,096. The interest is charged up front as a reserve. So we're not actually paying the bank $486,996. They're just holding it back. So the loan for the pre-sales that we have generated, that we will have available to us from the bank against these pre-sale contracts that we have generated, will be $3,863,184,000. This is a loan that's called a pre-sale loan. It's a loan the bank will give us having the distribution agreements that the sales agent has generated as a security. So it's basically an asset-backed loan against contracts. So we don't have to wait until the distributor gets the movie and then pays us. We can basically get the money up front, and the distributor then pays the bank. This is for the pre-sale loan. There is a second portion for our senior loan that the bank will give to us. That is called the gap loan. The gap loan is not provided against any contracts. The gap loan is provided against any sales we can still make. Now, how do we know what sales we can still make? It's very simple. Remember, we had total sales estimates for 9,170,000 in the take column. We then pre-sold a few territories, so we have to take these territories out of the estimates because they're no longer available for us to sell. So we're taking out pre-sales of 5,116,800, which leaves us with unsold rights we still can sell, of 4,053,200. Now, how does this translate into a bank loan? The bank will look at these unsold rights and provide a loan against it. A loan in the value of 50% of these unsold rights, up to 20% of our budget. If the unsold rights would be higher when we divide them by 2, so if this amount, the 2,026,600, would be more than 20% of the budget, then the bank will say the maximum you receive from us as a gap loan is 20% of the budget, irrespective of the amount of unsold rights you have. So 20% is always the maximum the bank will give us. So in this case, we are under 20%. We're at 16.68% here with our 2,026,600. Again, the 2,026,600 is 50% of the balance for the unsold rights, which is 4,053,200. So this is our gap loan portion. The bank will then again charge an interest reserve, and the interest reserve is 192,522 on this loan amount. So altogether, our gap loan would then be 1,834,73. If we combine the gap loan and the pre-sale loan, our total senior loan, which is the loan the bank will make available to us based on pre-sales we have made, based on unsold rights we still have available, is 5,697,257. So now we secured two financing components. One is our down payment of 767,520. The other one is our senior loan of 5,697,257. The third element of our finance plan for the experiment is the production incentive. I shot the film in Iowa, and the Iowa incentive comes down to 30% of my budget, which is 3,644,396.10. I then did not want to wait until the movie is finished and then go to the state of Iowa, show them all my expenses, and then get my production incentive. I got the incentive up front from a lender, meaning we did a cash flow of what we're going to spend in the region. We put together an assumption by an accountant that is approved by the lender for the tax credit amount, and that lender will then cash flow the tax credit to us, the expected projected tax credit amount, production incentive amount, and will charge us a fee up front for the loan and for this advance and all the work they do when they then contact the Iowa state authorities to get their money back after we have shot the film in Iowa. So they're charging me a lender fee of 25% of the Iowa incentive amount, which is $911,099.03. So I am left with $2,733,297.08 for my production incentive. So now I have three finance elements in my finance plan. The down payment that was given to me by the distributors at the time I secured the pre-sales, the bank loan against the pre-sale contracts and the rights I can still sell, meaning the unsold rights, and my production incentive. So altogether I have these three finance sources, and now I need to figure out what is my equity going to be in order to cover my budget of $12,147,987. And the balance to hit that budget number is $2,097,257. $949,912.93, which is 24.28% of the budget. So these three different sections, a bank loan, a incentive, and the equity, are the three pillars that are the main pillars for my finance plan, and of course the down payment in connection with the distribution pre-sales as well. So here's what's going to happen if and when my total estimates of $9,170,000 will change. So let's assume, let's move this over here. Here's what the finance plan looks like that we just talked about, right? All of this. Now let's assume, we're going to our assignment, we are changing the total take estimate, which is now, we're adding basically $500,000, and the total take estimates is now $9,670,000 instead of before $9,170,000. So what happens with our finance plan? Once we change the total take estimates and we then deduct the pre-sales that we have secured, our balance for the unsold rights is obviously higher. That balance is now $4,553,200 instead of before $4,053,200. So here, because our total take estimates have increased, the balance for the unsold rights have also increased. And this translates to a change in our gap loan, because the gap loan portion of the bank loan is driven by the unsold rights. So now that our unsold rights are worth $4,553,200, our gap loan gross amount is 50% of that, which is $2,276,600. If we then deduct our banking interest and loan fees of $216,227, we will end up with a gap loan of $2,060,323. So that gap loan amount is higher than before because it here was $1,834,73 because our unsold rights were less. Now that we have more unsold rights available because our take estimates are higher, our gap loan is higher. So the total senior loan is also higher because it's now $5,923,507 instead of before $5,697,257. So here we see the senior loan has increased. As a result, we need less equity. So our equity is now less. It is $2,723,662.93, which is 22.42% of our budget, versus before it was $2,949,912.93, which is 24.28%. Again, the reason why the equity is lower is because our senior loan in total is higher, which is based on the fact that our take estimates were increased by $500,000, which as a result increased the available rights we can still sell and therefore the gap loan amount. So I hope that this helps you a little bit in figuring out the experiment extra credit assignment. And always feel free to call me or text me or email me with any questions you have.